Hello everyone, I am Munir Muhammad Munir, teaching assistant at Faculty of Commerce, Cairo University. Today we are going to discuss Chapter 16, Cost Allocation, Joint Products and Byproducts, Part 1. Learning objectives of the chapter: Joint Cost Basics, Allocating Joint Costs, Approaches to allocating joint costs, Sell or process further. First, joint cost terminology. Joint costs are costs of a single production process that yields multiple products simultaneously. Split-off point is the place in a joint production process where two or more products become separately identifiable. Separable costs are all costs incurred beyond the split-off point that are assignable to each of the now identifiable specific products. Categories of joint process outputs. Number 1. Outputs with a positive sales value. Number 2. Outputs with a zero sales value. Product is any output with a positive sales value or an output that enables a firm to avoid incurring costs. Its value can be high or low. Main product is the output of a joint production process that yields one product with a high sales value compared to the sales value of the other outputs. Joint products are outputs of a joint production process that yields two or more products with a high sales value compared to the sales value of any other output. Byproducts are outputs of a joint production process that have low sales values compared to the sales values of the other outputs. Joint process flowchart. Here, single production process can result in steam, an output with zero sales value. This is not a product. And it also results in joint product number 1 and joint product number 2, and we may also have a byproduct. Joint cost allocation methods. Physical measures. Our first method: allocate using tangible attributes of the product, such as pounds, gallons, kilos, or other measures. Market-based: allocate using market-derived data or dollars. Number 1, sales value at split-off. Number 2, net realizable value. Number 3, constant gross margin percentage. So, our cost allocation methods generally divided into two approaches. First, we call it production approach, which depends on physical measures of our products. And second approach is a market-based approach using one of the derived data from one of these three approaches: sales value at split-off, or net realizable value, or constant gross margin percentage. First approach based on production, but the second approach based on sales. Physical measure method allocates joint costs to joint products on the basis of the relative weight, volume, or other physical measure at the split-off point of total production of the products. Sales value at split-off method uses the sales value of the entire production of the accounting period to calculate allocation percentage. Net realizable value method allocates joint costs to joint products on the basis of relative net realizable value of total production of the joint products. Net realizable value equals final sales value minus separable costs. Constant gross margin net realizable value method allocates joint costs to joint products in a way that the overall gross margin percentage is identical for the individual products. Joint costs are calculated as a residual amount. Sell or process further decisions. In sell or process further decisions, joint costs are irrelevant. Joint products have been produced, and a prospective decision must be made to sell immediately or process further and sell later. Joint costs are considered sunk costs. Separable costs need to be evaluated for relevance individually. Sell or process further flowchart. Single production process results in two joint products, joint product number 1 and joint product number 2. Our decision is to sell here at this point or to make further processing on joint product number 1 to reach final product number 1, and same for joint product number 2 to make further processing to reach final product number 2. Now let's solve a problem on this part. Let's start by solving problem number 1629. The cocoa factory manufactures and distributes chocolate products. It purchases cocoa beans and processes them into two intermediate products: chocolate powder liquor base and milk chocolate liquor base. These two intermediate products become separately identifiable at a single split-off point. Every 2,000 pounds of cocoa beans yields 50 gallons of chocolate powder liquor base and 50 gallons of milk chocolate liquor base. The chocolate powder liquor base is further processed into chocolate powder. Every 50 gallons of chocolate powder liquor base yields 650 pounds of chocolate powder. The milk chocolate liquor base is further processed into milk chocolate. Every 50 gallons of milk chocolate liquor base yields 1070 pounds of milk chocolate. Production and sales data for August 2014 are as follows, assuming no beginning inventory. Cocoa beans processed 28,000 pounds. Costs of processing cocoa beans to split-off point, including purchase of beans, is $62,000. Chocolate powder production 9,100 pounds. Its sales 6,500 pounds. Selling price is $9 per pound. Separable processing costs is $50,100. Milk chocolate, its production 14,980 pounds. Sales 13,500 pounds. With a selling price $10 per pound and separable processing costs $60,115. Cocoa Factory fully processes both of its intermediate products into chocolate powder or milk chocolate. There is an active market for these intermediate products. In August 2014, Cocoa Factory could have sold the chocolate powder liquor base for $20 a gallon and the milk chocolate liquor base for $60 per gallon. Here in this problem, we have a cocoa factory manufactures and distributes chocolate products. Our raw material here, or the main raw material, is the cocoa beans. Cocoa beans are processed into intermediate products, which are chocolate powder liquor base and milk chocolate liquor base. These are our main two intermediate products. These two intermediate products are further processed into two final products, which are chocolate powder and milk chocolate. Each 2,000 pounds of cocoa beans yields 50 gallons of chocolate powder liquor base, so 2,000 pounds of cocoa beans result in 50 gallons of our first intermediate product. And at the same time, it results in also 50 gallons of milk chocolate liquor base, our second intermediate product. In the further processing, 50 gallons of chocolate powder liquor base, the intermediate products, yield 650 pounds of chocolate powder, which is our final product. So each 50 gallons of the intermediate product number 1 results in 650 pounds from the final product number 1. And also each 50 gallons of milk chocolate, our second intermediate product, results in 1070 pounds of milk chocolate, which is our second final product. The actual data is that we have cocoa beans processed 28,000 pounds. So if we knew that each 2,000 pounds result in 50 gallons of chocolate powder liquor base and 50 gallons of milk chocolate liquor base. So if we have, instead of the 2,000 pounds, 28,000 pounds. So it will result in how much gallons of chocolate powder liquor base and how much gallons of milk chocolate liquor base. 28,000 pounds divided by 2,000 equals to 14. So 28,000 pounds will result in 50 multiplied 14, which equals to 700 gallons of chocolate powder liquor base, and also 50 multiplied 14, which equals to 700 gallons of milk chocolate liquor base. So first step, we knew that 28,000 pounds will result in 700 gallons of our first intermediate product and also 700 pounds of our second intermediate product. Then he said that each 50 gallons results in 650 from the final product and each 50 gallons of milk chocolate liquor base yields 1070 pounds of the final product. So now we have 700 instead of 50, and also 700 instead of 50 here. So 650 pounds also multiplied by 14 will equals to 9,100 pounds, which is given here the production pounds of chocolate powder, and 14,980, which also given as a production of second final product, milk chocolate. Let's summarize all what we said in a flowchart. Here we have cocoa beans. After processing it result in two intermediate products. First one, chocolate powder liquor base, and number two, milk chocolate liquor base. After further processing for the first intermediate product, chocolate powder liquor base, further processed into chocolate powder, and second intermediate product, milk chocolate liquor base, is further processed into milk chocolate. Here the amount of pounds of cocoa beans is 28,000 pound cocoa beans are processed and results in 700 gallons chocolate powder liquor base and 700 milk chocolate liquor base. Then the 700 gallons are further processed and result in chocolate powder 9,100 pounds and milk chocolate 14,980 pounds. From these 9,100 pounds, sales are 6,500 pounds, with a selling price $9 per pound for each pound we sold. Separable processing costs 50,100. Here, further processing cost for the first intermediate product is 50,100, and for the second intermediate product, here further processing costs is 60,115. For the milk chocolate, we have a production of 14,980 pounds. We sold only 13,500 pounds with $10 per pound as selling price, and we said separable processing costs. For this part in the problem, he said there is an active market for these intermediate products, meaning that if the factory wants to sell the intermediate products, which are the liquor bases, number 1 and number 2, the factory can sell it, but he will not sell them at this point. But if he wants to sell them, he could have sold the chocolate powder liquor base for $20 per gallon and the milk chocolate liquor base for $60 per gallon. Requirements: calculate how the joint costs 62,000 would be allocated between chocolate powder and milk chocolate under the following methods. Number 1, or A, sales value at split off. So we need to allocate the amount of joint cost 62,000 between two products, chocolate powder and milk chocolate, using sales value at split off point. Sales value at split off method. We have two products, chocolate powder liquor base and milk chocolate liquor base. At split off point, we are not talking about the final products, as we are here. Split off point, we have the intermediate products. So sales value, start with sales value of total production at split off. We calculated 700 gallons of the first intermediate product, chocolate powder liquor base, so 700 multiplied 20 results in $14,000. And for milk chocolate liquor base, 700 multiplied 60 results in $42,000 and total $56,000. This is the sales value of total production at split off point. So we need to allocate joint costs based on the percentage or on the weight of these two amounts. So we make percentage by dividing 14,000 divided by the total 56,000 results in 25% for chocolate powder liquor base and 75% for milk chocolate liquor base. So now we know the percentage of each product. We need to allocate the joint costs. Joint costs is 62,000. 62,000 multiplied 25% for chocolate powder liquor base will result in $15,500. And for milk chocolate liquor base will be 62,000 multiplied 75%, which equals to $46,500. And the total must be equal the joint costs we already allocated, 62,000. Then final step, we need to calculate production cost per pound. But here, when we calculate production cost per pound, we calculate it for the final product. So the costs of the final product will consist of two costs. First, its share allocated from the joint costs plus separable costs here for the further processing. So its share in the joint costs is 15,500 plus separable cost 50,100 divided by number of pounds 9,100, which equals to $7.21 per pound for the first final product, which is chocolate powder. Second, milk chocolate, 46,500 its share in the joint cost plus separable cost 60,115 divided by number of pounds of milk chocolate 14,980, which equals to $7.12 per pound. Requirement number 2. What are the gross margin percentage of a chocolate powder and milk chocolate under each of the methods in requirement 1? Here in requirement 1, we calculated or we allocated joint cost based on sales value. Let's now prepare or calculate gross margin percentage under the first method, sales value at split off. To reach gross margin percentage, we start by revenues. But here, revenues must be dependent on or calculated based on the number of actual sales, not the number of produced units. So, first product, chocolate powder, we sold only 6,500 units with a selling price, 6,500 pounds with a selling price $9 per pound. So revenues for chocolate powder equals to $58,500. For milk chocolate, we sold 13,500 pounds with selling price $10 per pound, which equals to $135,000. Costs of goods sold. We said we have two costs. First, joint costs, and second, separable costs. Joint costs allocated for chocolate powder is 15,500 and its separable cost 50,100. So total production costs for chocolate powder equals to 56,600. This is the total production costs, but we did not sell the full amount produced or all pounds produced. So we have here ending inventory. We must deduct the ending inventory to reach cost of goods sold. All units was 9,100 pounds. Sold 6,500 pounds. So 9,100 minus 6,500 will result in 2,600 ending in inventory. 2,600 multiply 7.21, which is the cost per pound, will result in 18,746. So cost of goods sold will equal total production cost minus ending inventory. So cost of goods sold for chocolate powder is 46,854. Gross margin will equal 58,500 minus 46,854, which will result in $11,664. So gross margin percentage will equals to 11,646 divided by 58,500, which will result in 19.9%. And the same for the second product, milk chocolate. Revenues calculated by multiplying selling price by pounds sold minus cost of goods sold, also calculated by adding joint cost plus separable cost, results in total production costs minus ending inventory cost, which will result in cost of goods sold. Revenues minus cost of goods sold will result in gross margin. Gross margin amount divided by revenues will result in gross margin percentage 28.8%. And this is our first method. Requirement B, physical measure based on gallons. Physical measure method based on gallons. Physical measure of total production. Our first intermediate product, 700 gallons, and we calculate 700 before by multiplying 50 multiplied by 14, and the same here was 700 gallons also, with a total 1,400 gallons. The weight or the percentage will be 700 divided by 1,400, which equals to 50%, and also the same here is 50%. Now we need to allocate joint costs based on these percentage. Joint cost 62,000 multiplied by 50% will equal 31,000, and here also 31,000, and the total also must equal 62,000, the joint cost. Now we need to calculate production cost per pound. Its share here from joint cost is $31,000 plus separable cost 50,100 divided by 9,100 pounds will equals $8.91 per pound, and here 31,000 share or joint cost plus separable cost 60,115 divided by 14,180, which will result in $6.08 per pound. Here calculation of gross margin percentage. We start by revenues 58,500 calculated by multiplying 6,500 unit multiplied by $9 and 13,500 multiplied by $10, with the total revenues 193,500. Cost of goods sold, joint costs 31,000 plus separable cost 50,100. Total production costs 81,100 minus or deducting ending inventory. Ending inventory is 2,600 unit 2,600 pound multiplied by 8.91, which is the cost per pound, will result in 23,166. Total production costs minus ending inventory cost will result in cost of goods sold with the amount of 57,934. Total revenues 58,500 minus cost of goods sold 57,934 will result in gross margin with the amount of 566. Gross margin percentage $566 divided by 58,500 will result in gross margin percentage 0.97%. And here also the same for second product, milk chocolate. Total revenues calculated here. Total production costs minus ending inventory will result in cost of goods sold. Total revenues minus cost of goods sold will result in gross margin. Gross margin amount divided by total revenues will result in gross margin percentage. C. Net realizable value. Net realizable value depend on sales value here minus separable costs to reach joint costs, and then we can allocate the joint cost. So here total sales value minus separable costs, we reach net realizable value. Based on this net realizable value, we can allocate joint costs. So first step, we need to calculate final sales value of total production. Total production is 9,100 pounds. Multiply $9 per pound will result in $81,900. For milk chocolate, 14,980 multiplied by 10 will result in 149,800. Then we can deduct separable costs. Separable costs for chocolate powder is 50,100. By deducting separable cost from final sales value, we can reach net realizable value at split off point. So for chocolate powder, net realizable value at split off point will equals 81,900 minus 50,100, which will equals to $31,800. For milk chocolate, net realizable value at split off point will equals to 149,800 minus 60,115, which will equals $89,685. Here we reached the net realizable value for chocolate powder and for milk chocolate. Total net realizable value is 121,485. Now we need to calculate the weight or the percentage of net realizable value for each product. For chocolate powder, 31,800 divided by 121,485 will result in 0.2618, and for milk chocolate 89,685 divided by 121,485 will result in 0.7382. Allocating joint cost based on these weights, 62,000 multiply this weight will equals to 16,232, and here 62,000 multiply 0.7382 will result in 45,768, and the sum of the allocated joint cost for chocolate powder and milk chocolate must equal 62,000. Production cost per pound equals the share of joint costs for the first product 16,232 plus its separable costs, which was 50,100, divided by number of pounds 9,100 will result in $7.29 per pound for chocolate powder. For milk chocolate, its share in joint cost 45,768 plus its separable cost 60,115 divided by total number of pounds 14,980 will result in $7.07 per pound of milk chocolate. Calculating gross margin percentage. First, revenues as calculated before 58,500. Cost of goods sold, its share in joint cost 16,232, its separable cost 50,100. Total production costs will result in 66,332 after deducting ending inventory by multiplying 2,600 pounds in ending inventory multiply cost per pound 7.29 will equals to $18,954. Total production costs minus ending inventory will result in cost of goods sold with the amount of 47,378. To reach gross margin, we deduct cost of goods sold from revenues 58,500 minus 47,378, so gross margin will equal 11,122. Gross margin percentage equals to gross margin divided by total revenues, which equals to 19%. For the second product, we calculated revenues, cost of goods sold calculated by adding joint cost and separable cost, resulting in total production costs. Deducting ending inventory from total production cost would result in cost of goods sold. Deducting cost of goods sold from total revenues will result in gross margin, and gross margin amount divided by total revenues will result in gross margin percentage for the second final product. Requirement per D, constant gross margin percentage. Constant gross margin percentage is calculated in two steps. Step number 1, we calculate final sales value of total production for the two products. We have first product 9,100 pounds multiplied by $9 plus number of pounds of second product 14,980 multiplied by $10. So total sales value of the two products will result in 231,700. Then we deduct both joint cost and separable costs, also for the two products. The joint costs for the two products is 62,000, and separable cost for the first product is 50,100, and for the second product is 60,115. So the summation of the joint and separable cost for the two products will result in 172,215. Final sales value minus total joint and separable cost will result in the gross margin for the two products 59,485. So now we can calculate gross margin percentage for the two products by dividing gross margin 59,485 divided by final sales value of total production 231,700, which will result in 25.6733%. This is the first step, is to calculate gross margin percentage for the two products, and we assume that the gross margin percentage is identical for all products. Step number 2 is to allocate joint costs based on the gross margin percentage. We see how to calculate it now. Step 2. Final sales value of total production for chocolate powder product 1 and milk chocolate product 2. The total sales value we calculated here will also calculated here, but for each product alone. So 9,100 multiplied by 9, $81,900, and 14,980 multiplied by 10 is 149,800. Deducting gross margin using overall gross margin percentage of sales previously calculated in step 1. So final sales value multiplied by 25.6733 will equals to 21,026. 21,026 is the gross margin for chocolate powder. So if we deduct gross margin from sales value, it will result in total production costs. Then, if we deduct separable costs from total production cost, we will then result the joint costs allocated to the first product. Here, 81,900 is the total or final sales value of total production. Gross margin for chocolate powder product is 20,026. Final sales value minus gross margin will equals to total production costs for the first product 60,874. Total production cost consists of two types of cost, separable cost and joint cost, and separable cost is given by 50,100. So total production cost 60,874 minus separable cost 50,100 will result in joint costs allocated to chocolate powder product with the amount of 10,774. And the same for milk chocolate. Final sales value minus gross margin will result in total production costs minus its separable cost will result in $51,226 joint cost allocated to the second product, and production cost per pound calculated by adding joint cost plus separable cost divided by total number of pounds will result in $6.69 per pound of chocolate powder and $7.43 per pound of milk chocolate. Gross margin percentage, revenues as calculated 58,500 and 135,000. Costs of goods sold, first joint costs 10,774 plus separable cost 50,100 which will result in production cost 60,874, deducting from it ending inventory with the amount of 17,394, which will result in cost of goods sold 43,480. Total revenues minus cost of goods sold will result in gross margin of 15,020. Gross margin 15,020 divided by total revenues 58,500 will result in 25.7%. The same for the second product. Total revenue is calculated. Cost of goods sold calculated by adding joint cost and separate cost, then deducting ending inventory to reach cost of goods sold. Total revenues minus cost of goods sold will equals to gross margin. Gross margin divided by total revenues will result in gross margin percentage 25.7%. Requirement number 3. Could Cocoa Factory have increased its operating income by a change in its decision to fully process both of its intermediate products and show your computations? Further processing of chocolate powder liquid base into chocolate powder. Incremental revenue we get from the further processing of our first intermediate product to reach our final product. Incremental revenue will equals to 81,900 minus 14,000. 14,000 is calculated as $20 per gallon multiplied by 700 gallons. So we have here incremental revenue with amount of 67,900. This is the difference we get from further processing and not to sell the first intermediate product at split of point. And incremental costs is the cost of further processing, or it is simply the separable cost 50,100. So we have incremental revenues with the amount of 67,900 and incremental costs only 50,100. So we have incremental operating income from further processing with the amount of 17,800. So it's better to further process our first intermediate product to reach our first final product. For the second intermediate product, further processing of milk chocolate liquid base into milk chocolate, incremental revenues are 149,800 minus 42,000, which will result in 107,800. Incremental cost of the second intermediate products are its separate cost 60,115. So incremental revenues 107,800 minus only 60,115 incremental cost will result also in incremental operating income from further processing with amount of 47,685. So it's also better to further process our second intermediate product to reach second final product. So Chocolate Factory should continue to process milk chocolate liquid base into milk chocolate and chocolate powder liquid base into chocolate powder. And by that, we reach our end of section today, part 1 of chapter 16.